Welcome to the Deep Dive. Today we're tackling IFRS 9 financial instruments. Think of this as your quick guide to understanding this key standard. We'll look at its purpose, what it covers, and, well, how it's changed over the years.
Yeah, and our goal really is just to demystify financial instrument reporting for you. We're drawing mainly from the official IFRS 9 documents themselves.
Okay, so where did it all start? It replaced an older standard, right? IS 39.
Exactly. IS 39 was, well, complex, and there was a feeling, especially after the financial crisis, that we needed faster improvements in accounting for financial instruments.
Faster improvements, okay.
So the IFRS 9 project kicked off, planned in 3 main phases initially.
Right, let's walk through that. So November 2009, that was the first big piece.
Yes, that's when the chapters on classification and measurement of financial assets came out.
So basically deciding what bucket an asset goes into and how you value it.
Pretty much. Then October 2010, they added the rules for financial liabilities.
What a company owes.
And that included some tricky areas like embedded derivatives, those mini contracts hidden inside others, and also how a company's own credit standing, its own credit risk, impacts the value of its debts.
Interesting. What about getting rid of assets or liabilities from the books? Derecognition.
Well, for that, they decided to just carry forward the existing rules from IS 39, for the time being anyway.
Okay, so a bit of old, bit is new. I see the effective date got pushed back in 2011.
It did. These things often take time to bed down. Then November 2013 was another significant step the hedge accounting chapter landed.
Hedging, like financial insurance against risks.
Exactly. And this was interesting because it gave companies a choice. You could stick with the old IS 39 hedge accounting rules or move to the new IFRS 9 approach.
A choice, okay.
Then, July 2014, the full, complete version of IFRS 9 was finally issued. Big moment.
What was new in that full version?
Well, it included some tweaks to classifying and measuring assets, specifically adding fair value through other comprehensive income for certain simple debt instruments.
Right, so changes in value wouldn't hit the profit and the loss directly.
Correct. And crucially, it brought in the new impairment requirements, the expected credit loss model.
Expected credit losses. That sounds like a big shift. Thinking about losses before they actually happen?
Precisely. It's a more forward-looking approach compared to IS 39, which waited for losses to be incurred.
Makes sense. Did the update stop there? Seems like standards keep evolving.
Oh, definitely not. In 2017, there were amendments linked to derecognition, specifically around insurance contracts following the new IFRS 17 standard.
Okay.
And another one about prepayment features where you might pay more if you repay early negative compensation, clarifying how to measure those.
It really feels like these changes often follow what's happening in the market or with other standards.
Absolutely. The interest rate benchmark reform is a perfect example. That hit in 2019 and 2020.
The LIBOR transition and all that.
Yes. Key rates were changing, so IFRS 9 needed updates for how that affected hedge accounting, contractual cash flows. It had knock-on effects on other standards, too, like IFRS 7 on disclosures.
So it's quite dynamic. What's been happening more recently?
Well, May 2024 saw amendments dealing with electronic payment systems and assessing those contractual cash flow characteristics, the SPPI test, plus related disclosures.
SPPI. Solely payments of principal and interest, making sure the instrument behaves like a basic loan.
You got it. And looking ahead, December 2024, we're expecting specific amendments for contracts linked to nature-dependent electricity.
Nature-dependent electricity. That sounds very specific.
It is. Things like power purchase agreements where the output depends on wind or sun. Specific rules on assessing if it's for own use and hedging those variable amounts.
Okay, so with all these changes, let's step back. What is the fundamental objective of IFRS 9? What's it trying to do for you, the person reading the financial statement?
Fundamentally, it's about establishing principles for financial reporting for both assets and liabilities. The whole point is to give you, the user, relevant and useful information.
Useful for what, specifically?
For assessing the amounts, the timing, and importantly, the uncertainty of a company's future cash flows.
Got it. So clarity on future money. Who does this apply to? Is it everything financial?
It's very broad. It applies to nearly all types of financial instruments, but like most standards, there are exceptions, such as things like interest in subsidiaries, associates, joint ventures. Those are covered by other standards. Also leases, employee benefit plans, equity instruments issued by the entity itself, and most insurance contracts.
You say most insurance contracts.
Yes, because there are carve-outs within insurance. Certain embedded derivatives, maybe a separated investment component, some financial guarantee contracts, even certain credit card contracts if they meet the definition of insurance. Those might fall back into IFRS 9. And entities can elect to apply IFRS 9 to certain insurance contracts too.
Complicated. What else is out?
Forward contracts for future business combinations, certain loan commitments, share-based payments. They generally have their own rules.
Okay, loan commitments. You mentioned they're mostly out, but didn't impairment rules apply?
Good point. Yes. While many loan commitments aren't in scope for measurement, the IFRS 9 impairment requirements, the expected credit loss part, do apply to them.
I see. So you still have to consider potential losses.
Correct. And the derecognition rules apply to all loan commitments too. Specific loan commitments that are fully in scope include ones designated at fair value through profit or loss, those that can be net settled, and commitments to provide a loan at a below-market interest rate.
Right. And back to that nature-dependent electricity point, those specific rules, can companies apply them to other similar situations?
No, the standard is very explicit. Those paragraphs are specific and shouldn't be applied by analogy elsewhere.
Good to know. Okay, so let's wrap up this deep dive on IFRS 9. What's the main thing you want listeners to take away?
I think the key thing is that IFRS 9 is comprehensive. It's the rule book for how companies account for their financial instruments. And it's constantly evolving.
Evolving to provide better information about future cash flows and risks, right?
Exactly. That's the core aim, providing relevant, useful information.
And the numerous amendments really show how financial reporting has to adapt to, well, the real world. New products, market changes, benchmark reforms.
Absolutely. It highlights that these standards aren't static. They have to respond.
So if this has piqued your interest and you want to know more?
Well, depending on your needs, you could dive deeper into the specific chapters. Classification and measurement is fundamental. Hedge accounting is complex, but important for risk management.
Maybe think about the types of instruments or industries you deal with.
Yeah, consider that.
Yeah.
What specific financial instrument are you most curious about? How do you think it gets accounted for under these rules? That could be your starting point for further exploration. Thanks for diving deep with Deepcast AI today. If you enjoyed this, give us a like and definitely subscribe and ring that notification bell so you're first in line for our next exploration.